It's September 23rd, 1998, a totally normal Wednesday, unless you're on the 10th floor of a Manhattan skyscraper where a bunch of guys in $5,000 suits were sweating harder than a cat at a dog show. Now who are they? Just the heads of like every major Wall Street investment bank, plus New York Federal Reserve. So yeah, just your average afternoon finance apocalypse. What had all these finance bros freaking out? A hedge fund. Not a war, not an economic collapse, just one hedge fund named LTCM, Long-Term Capital Management. And get this, it was run by an actual dream team, like the Avengers wore glasses and traded bonds, 2 Nobel Prize winners, a former Federal Reserve Vice Chair, and some PhD who could probably do your tax in their sleep. Basically, these guys were the nerds who make money rain. For 3 straight years, they were cranking out god-tier returns. We're talking like laughing at your mutual fund level returns. And then, surprise, they blew up hard. So hard that Wall Street, yes Wall Street, the land of eternal beef, had to hold hands, form a cardapuda and bail them out. Even the central bank stepped in like a frustrated mom saying, "Alright, I'll clean up your mess again." Now if you think that's dramatic, buckle up. The story is going to slap harder than the 2008 recession. Here's the deal. LTCM had this vibe like, we are too smart to fail. Their entire model was based on complex mathematical strategies, no vibes, no headlines, just charts, algorithm, and an unhealthy amount of confidence. And yeah, it gets technical. But trust me, if you follow the story, you're going to feel like you've unlocked a cheat code for understanding the economy. So let's rewind a bit. Early 90s. There's this mega famous investment bank called Solomon Brothers. Yeah, not the biblical Solomon, though some of their deals were straight up miracles. Inside Solomon Brothers was this tiny elite squad called a fixed income arbitrage group. A few dozen guys making over $1 billion a year. That's billion with a B. They were generating more than 80% of the bank's revenue, which basically make them the Beyonce of bond trading. Now, who ran this money printing dream team? A guy named John Merriweather, and so we'll call him Johnny. This dude was the guy, Wall Street legend, big brain energy. If you say credit spreads 3 times the mirror, Johnny would appear and explain them to you. So when he eventually left Solomon Brothers, everyone was like, oh damn, he's about to start something big. And spoiler alert, he did. It was called LTCM and it was about to either make history or become the biggest oops in hedge fund history. Alright, so Johnny and the brainiacs didn't just roll into Wall Street with swagger. They came in like, yo, let's outsmart the entire market. They built a squad that looked like academic version of Avengers. We are talking 2 Nobel Prize winners, a former Fed Vice Chair, and more PhDs than a university faculty Zoom call. These guys had Ivy League diplomas coming out of their ears. So what was the game plan? They raised $1.25 billion right out the gate, not by showing past performance, but purely on the vibe of we are geniuses, trust us. And guess what? It worked. Because the returns were unreal. 1994, 28%. 1995, 59%. 1996, 57%. 1997, 25%. And that was before fees. These dudes were printing money like it was going out of style. But here's where it gets juicy. Their strategy wasn't based on market news, intuition, or vibes. Nope, it was mathematics. Just pure, cold, emotionless math. They were like, screw your earnings report, we got models. And their crowd jewel, a move called Convergence trade, aka the we found a glitch in the matrix strategy. And here is how it works. Imagine 2 financial instruments like bonds. They are super similar. Let's say one of them is a 30-year US Treasury bond, and the other one is a 29.5-year Treasury bond. Basically twins. In a normal world, their prices should be nearly identical. But sometimes, due to short-term weirdness, the liquidity issues or market panic, their prices diverge. So LTCM would buy the cheaper one, expecting it to rise, and short the expensive one, expecting it to fall. Sit tight, wait for them to meet in the middle. That price gap closing, that's the profit. It's like seeing 2 Starbucks stores across the street selling the same latte, one for $4, one for $4.50. You buy from the cheaper one and short the expensive one. betting that the price will align eventually. And since you are long one and short the other one, you don't care if the whole market goes up, down or sideways. You are just surfing that sweet spread. Now multiply that by hundreds of trades across the globe in bonds, equities, swaps, futures, all converging plays. It was like a symphony of mispriced assets. But here's the rub. Each trade only made about 1%. How do you make serious money off 1%? Easy. Leverage. LTCM borrowed like crazy. We are talking 30 to 50 times their capital. So that little 1% trade, boom! It's now 30 to 50% gains if it works. But if it doesn't, if the market don't behave, you are toast. You might be thinking, well, how did the bank let them borrow that much? Because they looked safe. Because the model said risks were tiny. Because the nerds were saying, trust us. And Wall Street was like, yeah, okay, have all our money. Spoiler, Wall Street is about to regret that. Okay, now we get to the twist. Remember how their whole strategy depends on these trades being unrelated? Like, my bond trade has got nothing to do with my stock trade, kind of unrelated? Well, that's true until the market has a mental breakdown. Enter the Asian financial crisis of 1997. Countries like Thailand, Indonesia, Korea, total chaos. Suddenly, LTCM's trade that weren't supposed to be connected started tanking all at once. It's like being in 9 different group chat and all of them started fighting at the same time. But LTCM was still riding high. They were like, nah, don't worry. Our model says it's fine. By the end of 1997, they even returned money to their investors. Yeah, they were like, we're so good, we don't even need your money. That move, that big flex, was also a huge mistake. Because up next, Russia. August 1998. Russia defaults on its debt. Global markets, they freaked out crazier and harder than Twitter during a celebrity breakout. Everyone ran to safe assets like US treasuries. Guess who was shorting those? LTCM. Guess who was betting volatility would stay low? Also LTCM. Guess what volatility did? Boom! Skyrocket. Those perfectly balanced trades now bleeding cash. And when I say bleeding, I mean hemorrhaging. We are talking about 1.8 billion in losses in just a few days. But they weren't dead yet. They could have survived if, and this is a big if, the market chill out and stop panicking. But instead, Wall Street smelled blood. So LTCM, bleeding out like a player in the battle royal, tries to call in reinforcement. Johnny hits up Buffett, no dice. Tried Soros, nada. Desperate, he goes to Goldman Sachs. Goldman, well, sure bro, tell us everything, we'll help. Then they immediately dump similar trades from their own books. That is not helping, that's sabotaging with a smile. Then Johnny does the unthinkable. He sends a letter to investors admitting how bad things are, hoping they will reinvest. And Wall Street is like, oh man, he's begging, this dude is toast. The letter leaks, Bloomberg puts in the front page, and now everyone knows LTCM is in trouble. Banks who were cool yesterday suddenly want their money back. Imagine getting 100 texts from your exes who are asking for their money they once gifted to you. So LTCM starts to fire sell everything they can just to stay afloat. But with their trades being so huge, every sale tanks the market even more. It's like trying to fix a sinking ship by drilling more holes. So at this point, LTCM is down to 400 million. Still has like $1 trillion in exposure. Let that sink in. The Federal Reserve looks at this mess and goes, if LTCM goes down, the entire market might follow. So they do what any rational central bank would do. They locked all the big Wall Street banks in a room and said, figure this out. And they do. 14 banks cough out 3.6 billion to take over LTCM. Why? Because if one domino fell, they would all fall. Now here's the kicker, and this part is bananas. To calm the chaos, the Federal Reserve cut interest rates by 0.25%. Yup, they hit the economic panic button. That kind of rate cut only happens in major disaster. I'm talking 9/11, Lehman Brothers in 2008, the COVID crash, and LTCM. The hedge fund got itself on that list. Think about that. This wasn't a bailout, this was a save the entire system emergency move. Over the next year, LTCM slowly dies a quiet death. Johnny starts another fund. Doesn't go far, the Nobel Prize guys quietly goes back to teaching. Now, so what killed LTCM? Leverage? Sort of. Hubris? Definitely. But the real killer, trusting models more than reality. They thought math would save them, but markets aren't math problem, they are people. And people are irrational, panicky, and sometimes downright chaotic. That's the T. LTCM flew too close to the sun with a calculator. And Wall Street, never forget. What can you learn from this? Alright, now we've watched the Avengers of Wall Street get bodied by their own math. Let's break this down into 3 actual lessons you can use with stats to back it up. Lesson 1. Leverage is a double-edged sword and it cuts deep. LTCM was leveraged up to 30 to 50 times. That means a 2% loss could wipe out the entire portfolio. And it did. Here's a stat. According to 2021 BIS report, hedge funds using leverage over 20 times have a 42% chance of forced liquidation during market stress. Here's the translation. The more you borrow, the faster you get margin call into oblivion. Lesson 2. Models don't predict panic. Humans cause it. LTCM's models said things like, this event is a 1 in a billion. But surprise, 1997 Asian crisis, 1998 Russian default equals to real-world chaos. In fact, a study from the Journal of Finance found that during the 2008 crash, correlations between asset classes spiked to over 90%. This is like your whole entire diversified portfolio deciding to have a panic party together. Lesson number 3. Ego kills more portfolios than backstop picks. LTCM returned money to investors in 1997 because they said they had too much capital and too few good trades. Now, spoiler, they blew up a year later. According to a 2020 CFA Institute survey, over 60% of investment mistakes made by fund managers were traced back to overconfidence bias. Not lack of skills, not lack of research, just good old I got this energy. So yeah, LTCM, massive IQ, but even bigger blind spots. Let their losses be your cheat code. Trade smart, stay humble, don't leverage yourself into a TED Talk on failure.